All right, good morning, everyone. My name is Erin Clark, and I will be discussing with you all this morning revenue recognition for contracts with customers. So just to give you a little bit of background for those of you who do not know me personally, I joined SEK in 2009, so I have been here for 11 years now. I graduated from Mount St. Mary's University with a bachelor's degree in accounting, and then a few years later, I also graduated from the Mount with a master's in business administration and a finance concentration. So related to nonprofits, I spend my time doing about 12 to 15 nonprofit audits each year. And those clients range anywhere from annual revenues of around $500,000 to well over $100 million in annual revenue. So nice range of smaller and larger size organizations, as well as medium size right in between. I also serve as a board treasurer for 3 local nonprofits in Washington County, Maryland. And so aside from my role as an auditor, I sort of get to see the other side of things and issues that impact nonprofits. And just a fun little fact that has absolutely nothing to do with my job is I am a game show addict, and specifically Wheel of Fortune bucket list item is to actually be a contestant on that show. So just a little fun fact, if you will. So we have a lot of content here. It's going to be very high level this morning in the short amount of time that I have with you all. So we will be going relatively quickly, but just to give you an overview, we're going to be reviewing the new revenue recognition guidance that is effective. A lot of our nonprofits have already implemented, and if you have not, you will be soon. We're also going to be reviewing just in general different revenue streams of your organizations so that we can talk about which revenues are impacted by the new guidance. We're going to walk through the 5-step process, again, extremely quickly and very high level. We'll also discuss grants and contributions and how those may or may not be impacted by the new revenue recognition guidance. And then, as I'm sure all of you are eager to hear about, we will be talking about the impact of COVID-19 and then specifically the impacts to your individual organizations and how your organizations are impacted by the new standards. So just to do a quick recap of the new revenue recognition standard, for those of you who have calendar year end 12/31/19, especially if you are audited and your audits were performed relatively early in 2020, you most likely have already implemented this standard. However, for a lot of our June 30 year ends or other fiscal year ends, if your audit timeframe is later in the year, you may be able to take advantage of the delay that has been proposed by the Financial Accounting Standards Board. And so if you have not implemented it yet, my hope is that this presentation will help you keep in mind factors to consider when you do implement it. And for those of you who have already implemented it in your 2019, or if you have an early fiscal year end in 2020, my hope is that you'll be able to use some of this guidance to assist you in your analysis for FY20 and going forward, and especially factoring in these COVID considerations. One thing I want to point out with the revenue recognition that I'm talking about, revenues from contracts with customers, while that standard has been delayed, there is a related standard that clarifies accounting guidance for contributions, and that has not been delayed. So even if you have not yet implemented the RevRec guidance or you're not planning to this year, you will still have to adopt this Accounting Standards Update 2018-08, which gets into how you properly recognize grants and contributions, and also clarifies in which cases some of those transactions may actually fall within the scope of ASU 2014-09. So let's talk about contracts with customers. And in this case, depending on your business model, when I say customers, I might be referring to members, patients, whoever it is that you are providing goods or services to, for which you're receiving some sort of consideration. The most likely consideration is going to be monetary, some sort of financial consideration, but that's not the only type. So some examples of contracts that my non-for-profit clients have are things such as membership dues, right to use assets such as gym equipment or a facility rental, product sales, and this can include publications, food, store inventory, lots of different items there. Childcare, we're seeing that a lot more now, even as COVID expands with distance learning, that some organizations that maybe were doing childcare before have now expanded that for distance learning, or maybe organizations that were not doing that found an opportunity to do so. And so that's a big one right now as well. Also, pet adoptions and veterinary services for local animal shelters, as well as nonprofit veterinarians, and then healthcare services. I do spend a good bit of my time with healthcare related nonprofits. And so things like patient visits, ambulance transports, et cetera. These are all types of contracts with customers that your organization may have that would fall under the revenue recognition guidance that we're talking about. So step 2, after you identify the contract, is to identify the performance obligations. Depending on your organization, this can be relatively straightforward, or it can be a little more complex. So what I'm asking here is, what do you have to give to your customer, your member, your patient, in order to satisfy the contract that you've identified? And if you have goods and services, or I'm sorry, if you have goods, it's likely going to be pretty straightforward. If you have a promise to transfer one distinct good, you're likely going to have a single obligation. One example that I can think of a local client that has store inventory, that obligation is going to occur at the point of sale. A customer comes in, makes a purchase at the register. At that point, you have satisfied the performance obligation. However, there could be multiple obligations, which would be a promise to transfer multiple distinct goods. The other piece where this can get a little bit more complex is in services. So again, for my healthcare clients, there may be a single obligation, which would be one patient visit, one ambulance transport. Outside of healthcare, maybe it's a one-time facility rental or something that you are providing a single service that is done at one point in time. However, if you have multiple obligations within one acceptance of one fee or something like that, this could be along the lines of an annual membership dues, a monthly gym membership, something that spans a period of time, and that could alter the way that you recognize revenue. So steps 3 through 5 on a very high level basis, again, if I had more time, we could certainly get into this in much more detail, but steps 3 through 5 of this process would be to determine and allocate the transaction price and then ultimately recognize revenue. As I mentioned, the sale of products typically are relatively straightforward. What I'd like to give you an example of is an example of multiple performance obligations for one price. And the example I'm going to use here is a museum membership fee. So let's say you're a museum and you offer membership fees, annual fees, and let's say that those fees provide your member with multiple benefits. Perhaps that gives them unlimited admission for the entire year, however many times they'd like to visit. Maybe that includes a discounted parking fee when they do come to the museum. And maybe you provide a quarterly publication in the form of a newsletter that goes out to those members. In that case, you are providing multiple distinct performance obligations that you have to recognize that revenue allocated among different obligations. So, for example, you want to take into consideration how many times the member may visit your organization and the standalone value of the different obligations that you have. The other factor to consider is that the fees may not be 100% reciprocal. There may be, and often is, a contribution component. So in my example of the museum membership fee, maybe the member pays $300 a year, and maybe the overall value of the benefits provided is only $200. So in that case, the remaining $100 would be a contribution to the organization, and it would not fall under the revenue recognition guidance. It would fall under the contribution guidance, which we're going to discuss here in a minute. The other factor to consider, a lot of our nonprofits have special events, annual events that bring in a fair amount of their revenue. And oftentimes those events have sponsors. So there is a value of benefits to the sponsor or the ticket holder. That may be the value of a meal at the event. That may be some ongoing media recognition or promotion throughout the time leading up to the organization or to the event. And in some cases, we see a lot of activity-related benefits, such as a golf game or a comedy show. And so the idea there is to allocate what portion of that sponsor is actually for the value of benefits received by the ticket holder or the sponsor, and again, what is just a contribution to the organization. And so the piece that has some sort of reciprocal value there would fall under the guidance of revenue from contracts with customers. And then of course the contribution piece would fall under the contribution guidance. So let's talk now about grants and contributions. And I think typically here, a lot of people think if it's a contribution, there's nothing of reciprocal value, and that's not always the case. So what I'd like to point out is factors to consider. If your organization receives a grant, and it doesn't have to be just the recipient, if you're a provider of grants or you're a granting agency, it could be both sides here. If it's reciprocal in nature, and that means if the grantor is receiving something of commensurate value, then the guidance that is going to govern that revenue recognition is ASU 2014-09, which is revenue from contracts with customers. However, if it's non-reciprocal, meaning an organization or a donor is providing your organization with funds that they are not receiving something of commensurate value in return, then it would fall, if it's unconditional, it would fall under the contribution guidance, which has been clarified by the Accounting Standards Update 2018-08. I'd also like to just stop a second here and let's talk about the idea of conditional versus unconditional contributions. This is not to be confused with restricted and unrestricted and donor restricted, but the idea here is just the timing of the revenue recognition. So if you receive a grant or a donation that has a condition, what that means is that there is some barrier to overcome before you are able to recognize that revenue. One area that we see this a good bit is in the idea of a donor match, where a donor says, if you raise X amount of dollars for an event or a certain project, we will match those funds. You are not, as the organization, you are not entitled to that match unless you have raised the original requirement. So until that condition is met or until that barrier is overcome, there would not be any revenue recognition. However, once the revenue or the contribution becomes unconditional, at that point, you are able to recognize it. And at that point, it falls under the guidance, again, if it's non-reciprocal, under the contribution guidance. And then you would simply have to determine if there is a donor restriction that requires you either to use the funds, hold the funds for a period of time, use them for a specific purpose, or maybe it's an endowment set up to be held in perpetuity. At that time, you then determine whether it's donor restricted or if you can record it completely as unrestricted revenue. So now let's talk about COVID-19 impacts. And I know we've heard a lot this morning from the different presenters on how COVID is impacting your organization. And likely you have spent a lot of time evaluating this already. But if you haven't, here are some considerations to take in terms of implementing revenue recognition. First and foremost, if you haven't already started to see a reduction in your grants and contributions, you likely will be due to donor uncertainty and just increased needs in the community. We're in a very saturated community of a lot of nonprofits and a lot of organizations trying to do a lot of great things and diminishing resources. And so you will need to consider other revenue streams to potentially supplement the possible reduction of those grants and contributions. As was mentioned earlier, the CARES Act has come out with a substantial amount of additional funding for certain organizations to supplement that. And with that comes increased compliance requirements and the need to be aware of what you need to actually spend that money on. But all in all, especially our smaller nonprofits, we really expect to see a reduction in those grants and contributions. You also want to consider the impacts of temporary shutdowns. One thing that came up with one of my clients is how to properly account for revenues that previously would have been under the revenue from contracts with customers guidance that now may fall under the contribution guidance. And in this particular instance, the client was forced to shut down, completely close its doors for 3 months. And so before, some of the program revenues that were being recognized, these programs weren't able to happen. They weren't providing those services to the members anymore. And in some cases, the members asked for their funds to be extended when the building was able to reopen. But in some cases, they just said, no, we know times are rough and we want you to be able to continue doing what you're doing. So we're now treating this as a contribution. And so there is a possibility of revenue streams previously being considered contracts with customers that may now not fall under that guidance. Your revenue streams are also likely going to look a lot different than they would in a normal year. Again, just because of all of the uncertainty. And as I have here a little bit further on down the slide, is a lot of special events. You know, I know tons of our clients as well as organizations that I'm involved with on their board. We've had so many instances where special events had to either be postponed or completely canceled, or maybe they were just redone altogether in some sort of virtual format. But that is absolutely going to affect how their revenue streams look. Also, the ability of customers to continue paying in accordance with contract. So not only are the grants and contributions potentially going to decline, but if you have ongoing contracts with customers, say an annual gym membership, or again, the childcare fees associated with distance learning, or just overall childcare, daycare, and even healthcare, you know, you've likely already looked at what, specific to healthcare, you know, there's this concept of contractual allowances and what you can ultimately recognize based on what the other party is willing to pay. But you're going to have to really look at these contracts that you have and look at the ability of your customers to continue paying. And what you may find is that those contractual allowances or allowances for bad debt estimates need to be revised to factor that in. And then again, as I mentioned, decline in special event revenue. Even now, as things are starting to have a little bit increasing availability to do some of these in-person events, you may still be limited to the amount of people who you can have at a venue, and also the general unwillingness of people to be in large gatherings may also impact your special event revenue. So how might this impact your organization specifically? A lot of examples here, but let's just kind of finish up here with what this means specifically for your nonprofit. So for those who have not yet implemented the new revenue recognition standard, should you implement now or wait another year? And I would say that you really just want to consider the revenue streams and the volume of your program revenues and make that decision on a case-by-case basis. It is possible that and likely that if you have not yet implemented it, as chaotic and ever-changing as the environment is right now, it may make sense to wait a year to do that implementation, to do that analysis. But again, if 2020 is showing to be a complete different type of revenue and operations picture than what you're used to having, maybe it does make sense to go ahead and adopt now. What I will say for those clients of mine who have already implemented, that the qualitative components of the standard will far outweigh the quantitative aspect. And so what I mean by that is that with very few exceptions, are we going to see changes to the numbers in your financial statements? Oftentimes what we're seeing is just enhanced disclosures. And it oftentimes might even be an extra page or two of narrative in your financial statements to explain to the reader how the revenues and different revenue streams are recognized, and just again, going into more detail than likely what you've had in the past. And then I would, last 2 points here, I would say for those of you who have an audit or a review performed by an outside accountant, reevaluate your need for GAAP-based financial statements. Most likely, if you have an audited financial statement or review or whatever level, it's because you have some loan or grant agreement or some contractually binding requirement that some third party wants to view your financial statements that are shown in accordance with generally accepted accounting principles. But if you don't have that requirement, you may want to consider what we refer to as OCBOA statements, and that stands for Other Comprehensive Basis of Accounting. That could be an income tax basis, modified cash basis, or a little bit of a newer, relatively newer framework, which is a financial reporting framework for small to medium-sized entities. And because this revenue recognition standard is GAAP-based, if your organization does not issue GAAP-based financial statements, you would not need to implement it. So it is an opportunity to think about whether or not you really need those statements and need to go through the analysis either now or next year if you haven't already, versus if you can simplify the statements by issuing them within another framework. And then the other side is, again, for those of you who have already implemented RevRec, think about all of these things, consult with your auditor and accountant that, based on what we've talked about this morning, and see if the way that you implemented it last year, if you're still recognizing revenue the same way, or if things have changed again because of COVID and because of different impacts that the current environment has on your organization.